While investing in the stock markets, we always look at which stock is better performing. But what about investing for your retirement? Investors have a choice between two dedicated retirement vehicles, retirement funds and the NPS. But how do you evaluate which one is better for you? Hello and welcome, I'm Pallavi Sharma and you are watching Money Magic with ET Now. Today we compare the two retirement vehicles, retirement funds and NPS, and decide which is better option to invest in using 4 factors of analysis. Let's begin. Retirement funds, popularly known as pension funds, are investment options that allow you to save a little bit while you are still earning. Now, this fund will give you regular income after you retire in the form of annuity. Coming to NPS, or the National Pension Scheme, it is a government-backed scheme where you need to invest in a pension account at regular intervals during the course of your employment. And after retirement, the subscribers can take out a certain amount of the corpus and the rest will be given as a monthly pension post your retirement. Let's compare the two now based on 4 factors of analysis. Number 1, asset allocation. The NPS follows asset allocation based approach where investors have 2 choices, the active choice and the auto choice. Under the active choice, you can pick your asset mix. In auto mode, you can opt for 3 life cycle funds, the aggressive, moderate and conservative, catering to different risk appetites. Here, the asset mix changes automatically as the investor grows old. However, not all retirement funds have a built-in asset allocation mechanism. Only newer retirement funds have 3 to 4 variants or plans that are geared towards different investor profiles. Each plan has a different asset mix and investors can choose from them accordingly. Investors can also switch between plans at the time of choosing, even during 5-year lock-in period, or can also opt for an auto switch plan. While maximum equity allocation under NPS is 75%, retirement funds allow 100% allocation in pure equity plans. But NPS is still a winner here between the two because of 2 reasons. One, switches under NPS do not attract capital gains tax. Under retirement funds, investors will have to bear tax at every switch. 2, NPS allows more flexibility in asset allocation as it allows the subscriber to choose and pick the best fund manager. Number 2, withdrawals and liquidity. NPS discourages partial withdrawals and premature withdrawals. NPS accounts are locked till the age of 60. However, after completion of 3 years, a subscriber can withdraw up to 25% of the contribution for specific reasons. Up to 50% of the corpus can be withdrawn on completion of 25 years of service. Subscribers can also withdraw a maximum of 3 times in the entire tenure. After completing 5 years, 20% of the corpus can be withdrawn and at least 80% of that has to be used for purchasing annuity. On retirement too, only up to 60% of the corpus can be withdrawn as lump sum, rest of it has to be directed towards annuity. In case of the death of a subscriber, the legal heir can withdraw the entire corpus. While for retirement funds, after the mandatory lock-in period, investors can withdraw the full amount. They can also set up systematic withdrawal plans. Annuity payouts are also not mandatory here. So retirement funds win here. Number 3 is tax benefits. Contribution towards retirement funds launched recently no longer qualify for tax break under Section 80C. The capital gains tax is also applicable on withdrawal. Meanwhile, for NPS, up to 60% of NPS corpus withdrawn as lump sum is tax-free. The annuity, however, is taxable. Besides this, contribution to NPS is eligible for tax benefits under Section 80CCD1. NPS investments are eligible for deduction with an overall ceiling of 1.5 lakh rupees under Section 80C. Both salaried and self-employed can claim additional deduction of 50,000 rupees under the new Section CCD1B. If you are in old tax regime, you can claim a reduction of up to 2 lakh rupees. Further, tax liability can be brought down if the employer puts up 10% of the basic salary to NPS under Section 80 CCD2. Number 4 is costs. NPS charges a low fund management expense of only 0.09%. Retirement funds are much more costlier, charging a recurring expense ratio of up to 2.25%. So NPS wins here too. The score therefore is 1 for retirement funds and 4 for NPS. More tax benefits, less expenses, more flexibility makes NPS attractive, but forced annuity component and limited liquidity can be a bit of a setback. So well, for you to decide whether you need to choose a retirement plan or you need to choose an NPS. For more such informative videos, keep following ET Now.
If you like this video, then like, share and subscribe to ET Now.